I okay. Good evening, everyone, and again, welcome to the sixth class in the Los Angeles Urban League's second quarter webinar series. It's a pleasure to see everyone on the call, and happy to see so many familiar names. Glad everyone could join us in for tonight's course, which is titled "Understanding the Financing Process for Small Businesses." As many of you know, my name is Kenneth Allen, and I'm one of the co-directors of the Los Angeles Urban League's Entrepreneurship Center. If anyone on the call is not familiar with the Entrepreneurship Center or would like to learn more about the benefits that being a member of the Urban League can provide, please contact myself or my colleague Ty Umo, who is also on the call. Ty will put both of our email addresses in the chat so you can access us, ask us any questions that you have, or get additional information about the Urban League. I'll say just three quick things which summarize what the Urban League can offer you for anyone, who is not familiar. But it's really three areas. One is advice that's provided to small businesses and entrepreneurs through our business counselors, who essentially provide one-on-one technical support, advisory services, and strategic planning support for small businesses. And they're a valuable member of our team. Those business counselors in turn provide access to a number of things that the Urban League can also provide in terms of access to contracts, to events, and to other opportunities that help drive revenues. And then lastly, and most importantly, access to capital, which is vital for all businesses. I'm sure many of you have that top of mind. And it's a pleasure that we could bring tonight's topic to you and really expand your knowledge and awareness of the financing process. With that, I'd like to introduce the speaker for tonight's session, which is Kendall Simmons. And Kendall is a managing director and senior relationship manager in the corporate and institutional banking division of PNC Bank. Kendall began his career committed to improving economies within developing nations through the power of relationships, and then pivoted to really focus on financial services with a primary objective on advising investment leaders to make smart decisions in emerging economies. For more than 15 years, Kendall has worked in banking, beginning in investment banking, then commercial banking, corporate sales, and lending. He spent 6 years specializing in the aerospace and defense industry, focusing on cash flow lending and acquisition finance. And then recently in 2021, Kendall joined PNC Bank in Los Angeles as a senior relationship manager in the corporate bank, where he covers large corporate, mid-cap, and middle market clients and prospects to deliver PNC's integrated banking solutions and help satisfy their financing and strategic needs. With that, I'm going to turn the call over to Kendall. I will just make one note for all of our session participants. Unlike prior courses, our host unfortunately has a hard stop right around 6:10. So we're going to motor through his presentation relatively quickly, leave about 10 minutes at the end for any questions that you may have or discussions that you'd like to hold in the Q&A. But to kick off the class, while Kendall introduces himself and gives probably a little more context and color than I provided, if each of you could put in the chat just a quick snapshot and summary of the industries that you operate in or would like to operate in. And if you have a business, just provide a general sense of your revenues, whether you are over 100,000, over 200,000, or ideally over $1 million. Thank you, everyone, and have a great session this evening.
Great. And thank you very much. It's definitely a pleasure to be here. I would not have been able to make it this far if I didn't have organizations like the Urban League standing behind me. I think when I first started out, I had a lot of questions, and I was probably a little bit more apprehensive about banking in general. I think when I was in college and even after college, was not as trustworthy or appreciative of what a bank could do. I think after spending nearly 20 years in the financing industry, I'm actually very excited to talk to this group, especially business owners, about what a bank or a credit union can do for you, what the financial products that they offer can provide for you, and how to actually use the services that banks and financial institutions have at their disposal to help accelerate your development, your wealth growth, and helping you really get support for your business. So Ty and I are going to walk through a few different slides. I'm generally not a fan of walking through decks. I tend to be more conversational. What Ken laid out in terms of how this will flow, I will be a little bit more talkative at the start, showing you products, showing you services, separating out what a bank does, what a credit union does. But I really want to spend time, if you can, write down questions as I walk through these slides that are directly applicable to your business. And then we can spend the second half of this presentation answering some of those questions, or at least flushing out areas where you have concern. So to kick off, Ty, maybe we can go to slide 4. At any time people ask about what does a bank do, it's always interesting because I always think of, like, when I was a kid, I watched Scrooge McDuck, or I would watch these kind of wild cartoons where someone would have a sack of money. They'd go to a bank and they'd drop it off at the bank. And there was always this bloated person that would take the money and probably not help out whoever they took the money from. I would say in today's day and age that's the opposite. What I would share, what a bank does do, it takes your deposits and it doesn't just keep them. It takes your deposits and then lends those out for interest, and then gains that interest, and then the bank then deposits that back into the FDIC or into a federal institution where they get a return on those deposits. So essentially, what a bank does is it's more of a middleman. And what I want to leave with this group is you can learn to leverage the financial services that a bank offers to be your own middleman, to use leverage, to use interest on deposits to help your money work for you through compounding interest. And we're going to get into all of that, but just by being a little smarter of how a bank operates, what the financial services that a bank offers, and how you can use those. Let's see if it's additive to you, because I'd love to hear the questions at the end. Before you ever walk into a bank or a credit union or any financial institution, I always ask myself, why am I here, right? Is it, you could have gotten a check for your birthday, you could have a desire to buy your first home or to make an investment into a property. But you should consider, what are your needs and why am I here, before you ever have a banker, a teller, any person that works for a financial institution trying to tell you what you need. First, look at yourself and say, what are the services that I need today, right? Once you have an idea of what you need, if you want to get a return, for instance, on $100 that you just received, I would go to not just one bank, but I would go to a couple. I would go to 2 banks, a couple credit unions, or look online and see who's offering the highest interest rate. Right now, there's even a non-bank. Apple right now is offering 4% for cash deposits. So you can use your Apple wallet and make as much money, if not more, than what you could be doing at a brick and mortar right down the street on the corner, right? So questions you should always ask are, what are my needs? Do I need to get a higher return on my deposits, on my investments? Do I want to buy a home? Where can I get a mortgage? I want to get a business loan because I actually want to grow my own personal business. I want to start designing my own clothing line. I want to open up and start selling my own line of shoes, right? I want to be the next Yeezys. Always think first, what do I need? Ty, can we go to the next slide? Okay. So what financial institutions can you go to once you figure out what you need? So if we decide, okay, I want to deposit funds into a bank or into an institution, I want to get a loan. Where do I go? So there's different banks and saving associations. You've heard of Chase, PNC, Wells Fargo, to name a few. You probably see them on the corners. Things you might not see all the time are credit unions. Smaller, not as frequent, but still a depository institution. These are places that accept money and that lend money back out. They may offer products like credit cards, car loans, personal loans, mortgages, and other services like escrow services or insurance. These are all things that financial institutions offer. And it goes back to the original question. Before you walk into any of them, what do you need? Next slide, please. Okay, so we talked about financial institutions. We said that, okay, there's banks, but there's also credit unions. I've heard about both. I don't know really what the difference is between them, right? So for banks, banks have customers. If you walk in and have a check and you deposit it, you're going to get a bank account. You become a customer of the bank. Credit unions are a little different. You become a member of that credit union. So by taking money, putting it into that credit union, you are now one of the members of that union. For banks, is there membership criteria? No. If you have cash, you deposit it. Sometimes they'll give you your own checking account or savings account, and you get a card. That's it. You're now a customer that has access to the funds that you've put in there. There is membership criteria. Sometimes there may be a fee associated with a credit union. For banks, most of them are owned by shareholders. We talked about JP Morgan. If you wanted to, you can go and you can buy a percentage ownership of JP Morgan. It's going to cost you about $130, but for $130, you can get a share, meaning that you now are a shareholder and have the opportunity to vote and be a part of that bank. Credit unions are non-for-profits. The organizers are the members. So if you have deposits in a credit union, you're a member and you have some form of ownership of that credit union. Next slide. So what happened when some banks recently failed? We talked about the First Republic Bank, Silicon Valley Bank, among others, went out of business. If you took your money and you put it into that bank, a fear was that your money was gone. That led to people pulling money out of their bank accounts quickly. What the federal government has set up is what's called FDIC, Federal Deposit Insurance Corporation. And what that does is it's by law will protect your deposits up to $250,000 per person, per depositor. When these larger banks failed, what the federal government did is they guaranteed every dollar that was invested in those banks above and beyond the $250,000 insurance quota here. So what's changed is the federal government is saying, we want to protect banks to get past the idea of a bank is going to take my money. If they go out of business, I lose all of my hard-earned dollars. That's not real anymore. Right now, the federal government has stepped in. Most banks are guaranteed, if they're FDIC insured, to return $250,000 to you if you, for any reason, if that bank goes out of business. Next slide. For a credit union, similarly, depositors are protected and it's insured not by the FDIC, but by the National Credit Union Administration. So when I started the call, there's two things that I thought of. When I first went over to a bank, again, I was thinking of cartoons where there's a fat cat who took all my money, and if they ever got in trouble, it was gone. What I started to realize after I started working at a bank is, well, legally, my money that I put into whether a bank or a credit union by law is protected. So rather than, as my parents, I come from the West Indies, my parents are from St. Kitts and Nevis. They used to take their money and put it under the pillow, right? Because they were afraid that someone was going to take it. Nowadays, rather than putting it under the pillow, I tell my parents, take that money, put it into the bank because you know it's insured, and the money that you deposit is going to start to gain interest. And by you not doing anything other than putting it in there, you're starting to generate what's called passive income, meaning your money, that $1 you put in the bank, is starting to work for you and starting to earn you interest and a return. Next slide. Okay, so I have $100. I find a financial institution, either a credit union or a bank. What does that get me? Okay, well, the services you get are, you get into a retail location. So let's go back to JP Morgan. There's a bank, you see Chase banks on almost every corner. They're at Rite Aid, so on and so forth. What that means is you can now, with a checking account or a savings account, you can go to an automated teller, an ATM, put your card into any of these mobile devices, and you can have access to the money that you put in there. Generally, all of these institutions have phone service, automated service, electronic service, email service, where if you have a question, like we'll have tonight, you can email, you can chat, or you can call, and you can get information related to any of the money that you've put into these institutions. What I've found with technology, I'll be honest, I never even go into banks most days because if you have a smart device, you can open it up, and a lot of the banks now have a mobile app, and you can do mobile banking. So you can make a transfer from yourself to pay a bill. You can transfer to a friend. You can use multiple apps now to move money through electronic services. Okay.
Hey, Kendall, before you continue,
Please.
there's a question in the chat related to insurance on deposits. And the question from Mona F is, what happens if you have over $250,000 in the bank? What is insured over the FDIC or SIPC amount?
That's a great question. And the historic answer was, if you had over $250,000 and the bank went out of business, you would only be guaranteed $250,000. So if you said, for example, you had $500,000 in the bank went out of business, you would get back guaranteed $250,000. You would lose the other $250,000. However, what recently happened when First Republic Bank went out of business, if you had $500,000 at First Republic Bank, you got back $500,000 from First Republic Bank. And the federal government stepped in to make sure that every dollar that you had in that institution was returned to you, or that you had access to that. The go forward question is, if another bank were to go out of business, let's say Wells Fargo went out of business, would the federal government give you back every dollar you put in there? The honest answer, by law, is the bank and the federal government is not required to give you back anything other than what is federally insured. What is federally insured is $250,000. I don't know if that answered your question, but that's a good question. Any other questions in there, Ken?
Yeah, those ones. Sorry, there's a question here that says, "Where do you go to buy one share of JP Morgan, the company?"
That's a great question. That's a great question. I've worked actually with my son, who did a project for his school, and he said he wanted to buy, and I'm going to get to JP Morgan, but he said he wanted to buy a share of Microsoft or Apple. And I told him, you know what, let's do that together. So to go and buy a share, if you have a bank account, you can go to your bank, you can go into your branch, and you would set up a checking account or a savings account. And you could ask for an opportunity to buy, you basically would set up a brokerage account, okay? And you follow me for 1 second. Once you have a brokerage account, it would give you access to the New York Stock Exchange or the NASDAQ or the Russell 500, a series of what we call exchanges. And on the exchange, you're going to have what they call a ticker, or basically an identifier for whatever you want to buy. In this case, JP Morgan. JP Morgan would have a small ticker called JPM, and you would say, I want to buy 1 share of JPM. To buy 1 share of JPM, you'd go online. You can do it right now while we're talking. You can go into Google and you could say, how much does a share of JP Morgan cost? Google will spit out a number, or any of the exchanges would put out a number. You would say, I would like to buy 1 share of JP Morgan. And on the brokerage account that you set up at a bank, you would see in your account 1 share, or however many shares you would like to buy, of JP Morgan. But in order to access a share, you would have to go through a licensed broker dealer. And a licensed broker dealer is going to tell you the risks of trading. And one of the risks of trading is you can lose everything, or you could make a lot of money. Unlike a deposit account, which I think someone asked earlier, deposit accounts are FDIC insured. When you buy shares, shares are not insured. You can lose everything, or you could make a whole lot of money. So that is why you have to go through a broker dealer, and it usually requires setting up some form of a checking or savings account or a brokerage account. Ken, other questions?
No, not at all. You can continue to go through the standard presentation. Thanks,
Great.
Kendall.
These are great questions so far. Okay. And the last thing, when you're setting up, when you're accessing either your retail account or you're going to an ATM, if you have any needs, special needs related to hearing, vision, anything that requires accommodations, those can always be requested. And by law, they have to be compliant and they have to accommodate those. So people have already asked some really smart questions here. You know, how do I get a share of JP Morgan? Where do I go to get a retail account? Things that a lot of banks and financial institutions offer are deposit products. So we talked about that. Let's say it's your birthday. Grandma gives you $200. You can take $200 and you can go to your credit union, your bank, and you can open what's called a deposit account. And a deposit account gives you a little bit of return right now. For every dollar you deposit, you might get 2 cents after every period, right? There's credit products. So let's say you don't want to deposit money, but you want a loan. You want a personal loan, you want a car loan, you want a credit card. Those are products that are offered within a bank. And then let's say you've saved up your hard-earned dollars and you always wanted to have your first house or a condo or a townhouse. Banks and credit unions offer mortgages, right? You can go in and say, I would like to have a mortgage so that I can buy a piece of property, or I would like to get a loan to put a down payment so I can have a car so that I can commute to work, right? There's multiple products, and we'll continue to explore a few of them. Ty, can we go to number 11? Thank you. So we talked about depositing. So there's within the deposit products, there's savings accounts. So let's say you're not going to Target and buying groceries. Let's say you actually want to save for that car, or you want to save for that house. You can set up a savings account, right? Or you need something to help you with paying your weekly bills. You can set up a checking account. Or let's say you want to put something away in the safest place you can right now with low risk. There's what's called certificates of deposit, and you can get a 3-month, a 6-month, or a 1 year, or sometimes even longer certificate of deposit, which sometimes for me, I use it just because it means that I won't be able to access those funds for however long the certificate says. So if the certificate says it's a 3-month CD, that means you're going to take your $200 that you got for your birthday, you're going to put it in a CD, and that means you cannot touch that for 3 months, 6 months, 1 year, but what you're gaining is interest. And while the money sits, you're going to make money based on what the CD that you purchase, what this coupon or what the interest says that you're going to make when you go into contract on that. Okay. Similarly, there's money market accounts. These are short-term in nature, but you can take your $200 you got from your birthday, deposit it into a money market account, and that is going to be invested for you, where you can start to earn money while you work and get your normal income. Next slide. Number 12. There, 12. Thank you. So we talked about, okay, we can set up a deposit account. We can set up a savings account. What are the credit products? Okay, well, we can get credit cards. We can get lines of credit. So personal lines of credit, business lines of credit. Let's say you have, you wanted to open up a pastry shop. You're a great cook. You make amazing cakes. In order to buy the ingredients for your shop, one thing you might need is a line of credit from a bank to go and buy baking supplies, ingredients, an oven. In order to do that, we're going to get into it, but you're going to need to establish a bit of a credit history. You're going to need to demonstrate that you've been able to make payments consistently, right? But the idea that a bank can do, when we talked at the very beginning, we want to figure out how to make a bank work for you, where they can help you grow whatever you had in as your vision. Because remember, when we walk in, we want to think about, well, what do I need? What are my biggest issues that I need to have assistance with? One of those things are, okay, do I need a line of credit to help me with my small business or my personal loan? You can do installment loans. So paying off a portion of a loan over a longer period of time. Maybe you need 3 months to pay back a loan, maybe 6 months, maybe 12 months. So there's different options on how you can repay a loan. And then we talked about mortgages. A mortgage is basically a larger loan to purchase real estate. Can we go to number 13? A lot of this we talked about. This is just putting it into one grid where you can look through each of the different products, okay? And some of these have different aspects to them, but I want to keep moving because I think there's some other things we want to get to. Can we skip down to page 15, Ty? Okay. So what do you need? The reason you come on this call is to figure out, how can a bank help me? How can a credit union help me? So here's some ideas to help start that conversation. Okay. Do you need to save money? Are you spending money? Do you need help managing money? Or do you need to borrow money? Right. So going back to the original point, well, what are my needs? What is a bank going to help me with? I think this is a good starting point. If we did a case study, let's just look at an example. Ty, can we go to 16? So what do you need to manage your money? In this example, we have Susanna, and she's considering, what does she need to manage her money? She has a full-time job, receives a paycheck every 2 weeks, just like I do, like a lot of people do. She's had trouble in the past trying to pay her bills on time. She's had credit card debt. She wants to pay it off, but she also wants to build an emergency savings account. Susanna needs a car within the next year and wants to be able to get a good rate on her car loan. So how do we manage? How do we find her financial needs? All right. Ty, can we go to page 17? One way to start would be just writing down, what do I need? Because we heard her story, but what does she need? Okay, well, she needs to save money for emergencies. She needs to pay her bills. I guess she can use electronic payments to send money to family and friends. She probably is going to need access to cash quickly. She's definitely going to need to probably borrow money to buy a car. And she's looking to maybe improve or build her credit. Why would she need to improve or build her credit? Probably because in order to qualify for a loan, she has to demonstrate a record of being able to pay back loans and to have some type of a credit. And it might not be covered on this call, but at a certain point, we will need to talk about a credit profile, right? So when you're thinking about a FICO score or some type of a credit score, that is related to building a credit profile. And that does take a little bit of thought and a little bit of time, but it's not rocket science. It's very achievable, right? And then the last thing is, and most people don't think about this, but there actually is benefit to building a relationship with the financial institution. And I look at the last 2 points, building a relationship with the financial institution and improving or building your credit, they kind of go hand in hand. Because if you go into the same bank a few times, you've deposited money in there, your account, either savings, checking that we both talked about, that starts to grow. A banker may say, you know what, you've built enough of a checking or savings account. Would you ever be interested in a loan or a credit card? And if you ever decide to get a credit card, you maybe take a small amount of credit card and you pay that back on a regular basis because you never want to carry a significant amount of debt. But what you can do by getting a credit card, having a checking account, having a savings account, is you're going to demonstrate consistency at the bank with whatever banker that you're getting to know. As that financial institution gets to know you, you're building your own relationship and indirectly building a credit profile because those bankers are seeing the consistency in your ability to repay credit cards, keeping balances in your checking or savings account, and they can start to help you if you want to qualify for a loan for a car, or if you want to qualify for a mortgage. You now have built a profile within a financial institution. Okay, can we go to slide 18? So going back to the case study, we looked at our banking checklist. We talked about the things that we need. Now let's start to put these things in motion. So on page 19, sorry, time. Okay, so my needs and my access. So, okay, let's apply it. Checking accounts, savings accounts, debit cards, overdrafts, makes sense. Okay. So in order to meet my needs, and if I were to, you don't have to look at it, but I can tell you about it. So Susanna said she needs help managing her money, right? In order to do that, we said, okay, well, Susanna, you need to set up a checklist. Okay, so she went through and she said, I need to save money, I need to pay bills, I need to send money. Okay, let's do that. Then we said, okay, well, you built your checklist, we understand what you need. Now we need to build a relationship with the bank and help figure that out. So she set up a bank account, likely. She possibly gained some form of a card. In this example, under number 2, there's a reloadable prepaid card or a credit card, a checking account. She probably set up a savings account. On number 4, she's able to use her credit card or checking a card at ATMs to pull out money for emergencies. A lot of times banks will set up overdrafts and overdraft fees. So in order to make sure that she doesn't lose her money and she builds emergency savings, she can set up a savings account, link that to her checking account so she's never overdrawn. Her savings account will grow over time, will gain interest. So she's building small components to help her profile grow over time. And as we described earlier, if she manages it well, she builds a relationship with the bank, she might be able to start qualifying for larger purchases such as a car or a mortgage. At this point, I want to pause. If we can go to number 20, Ty. So we talked a lot about what are financial institutions, whether it's a bank or a credit union. What are some of the products they offer? Deposit accounts, savings accounts, credit cards, mortgages, loans. We talked about, well, what are my needs, and making sure we're considering our needs first. So maybe we build a checklist of what are our needs and how can we then make actionable requests from our bank or a credit union to help us meet those goals, right? All of that is critical to helping you establish a financial base to help you manage your business, to help you manage your personal wealth, and to start to grow and scale your net worth at the end of the day. The last thing I would say is don't be intimidated to go into a financial institution. Understand the general process for opening savings or checking accounts. They may ask for personal information from you, social security number, phone number, address, if you've had any bankruptcies in the past. What they're trying to do is create a profile because they don't want to sell you products that are not a good fit for what you're trying to accomplish. So before you walk in, I would go back to step 1 and say, well, what are my needs? When you get there, you can simply say, I want to open a checking account, a savings account, or I need a credit card. They may ask you to fill out some form of a template because they do have to create a profile for you, because by law, they're not able to just, they don't want to, 1, discriminate, 2, take money. You want to make sure that they understand what your needs are without selling you products that aren't a good fit for you, right? So they want to make sure it's a suitable product, okay? But go into a bank with confidence that at the end of the day, the banker on the other side of the table, their job is to service you. It's not the other way around. You're not giving them free money. You walk in because you have a need, and you need to verbalize that your need is X, Y, and Z and have your checklist. And then work with them to have them show you products and services that can help you achieve your goal. Okay. I'm looking at the clock. We're just about at 5:50. Ken, I want to pause right here because there were some intelligent questions in here, and I want to make sure we have enough time to answer any other questions or have a bit of a discussion here.
Absolutely. For everyone in the chat, feel free to ask any other questions that you have, either around the differences between financial institutions, finance companies, credit unions, commercial banks, community banks. If you have any questions about the differences, please feel free to ask those in the chat. In addition, if you have questions around the different types of products that a small business can take advantage of, again, feel free to put those questions in the chat as well.
If we have some additional time, I can keep going just in terms of what may be required when we're opening up an account.
Sure, absolutely.
Ty, do you mind dropping down to number 25? Okay. When we're opening up our accounts, there's two different ways to do it. You can apply online or you can apply it in person. Same outcome for both. You're going to complete an application. They're going to verify who you are. They're probably going to ask for your physical location, whether it's your home address or wherever you're staying. They're going to want probably to ask for your social security number. And then you decide whether you want to opt in, right? Once you have the account open, you can make your first deposit. You're going to receive in the mail, whichever address you give them, or if you decide to go paperless, you're going to receive a host of disclosures. You might even have to sign a couple documents just authorizing the opening of the account. They're going to activate your tools, and then you are suddenly off and rolling. You're probably receiving the mail, a bulky envelope. Inside will be a card. Generally, there's a portion on the card that asks you to call the number to activate or go online to activate your card. Once that's done, you're off and running. If you have any questions about the information, I think someone asked the question earlier about what happens to the money you put into the bank. Is it FDIC insured? So there's laws that govern what banks can and cannot do. Ty, can we go to page 26? So as a consumer, you can ask for banking history reports, right? If you want to know what your history is at a bank, you can find out if you have any negative balances on any of your accounts. If there's been fraud on any of your accounts, you can look into it. Some accounts have been closed by financial institutions. As a consumer, you're approved and authorized to get one free banking history report for any of your consumer reports. And this is, and the consumer reporting agencies are Experian, Free Credit, I think it's Experian, TransUnion used to be one of them, and Equifax. All three of those are credit unions that will keep a running log of all of your, whether it's banking activities, credit card activities, most of your financial activities, and that is used to build your credit profile, which then will be used to help you qualify for a loan, whether it's a car loan, a personal loan, or a bank loan. So again, building a relationship with your financial institution is important. Building credit is important. It takes time, but if you are patient and you do it the right way, it can be used to help you satisfy a need down the road.
Hey, Kendall, there's a question in the chat.
Okay.
And kind of on the topic of understanding how to build credit and so forth. The question relates to how do people adopt the mindset and get comfortable with using debt as a form of capital to grow their businesses? given
Man, that
a historic aversion to debt and borrowing, particularly within the Black and Hispanic communities?
man, that is one of the best questions, and just I think it's a critical question, because I think in the Black and Hispanic communities, like I said, I came from, my family came from the West Indies. We there's not a lot of banks down there, and I think when my father came, there was a lack of trust in governments in some of these countries, and when we came here, there was not necessarily a good reputation for some banks. And straight up, like, people were not comfortable giving all of their personal information away. That's one side of the discussion. The other side is, when you are afraid, it's sometimes just because we don't have all the information. What I try to tell, and I tell this to my family, to my kids, is not all debt is bad. Not all financial institutions are bad. What is important is knowing what your needs are and how to use those tools, because essentially all that a bank is, it's a tool that is there to allow you to grow your wealth. Now, we've never been taught that these tools can be used for us to meet our needs, right? Other people learn that. They talk about it at the dinner table, that building a credit profile is going to help you qualify for a loan where you will pay a lower interest rate. You will gain access to all these other things by being smart about how you invest. So, Ken, one direct way I would recommend to build credit is slowly. I don't think it works if you go out, you get a credit card, and then you spend all the money that you're allowed to spend on that credit card, because then you have a lot of debt and you're paying interest, and you are now feeling the stress of trying to play catch up to get out of that debt. What I try to recommend to people: first, build 6 months worth of savings, right? Go into a bank, open an account, set up a checking account, set up a savings account. Those two things will allow you to get in the habit of paying weekly bills, monthly bills. Try to keep a log, as we saw with the example of Susanna. Start to build an understanding of how much am I spending each month? Am I saving enough per month if you're getting paid every other week? I always recommend maybe taking 10% of that paycheck and putting it immediately away into a savings account. If you can, take an additional 10% and putting it into your checking account. And you're going to allow those to gradually grow. Once you get to a point where you have 3 months or 6 months worth of savings to help you in case of an emergency, then you can take potentially the next step, which is to go and maybe grab a small credit card. The reason for that is not because you want to get debt, but you want to demonstrate that you can buy something on credit and then pay that back. And what you're building is a story of how you handle money. And the better you are at buying something on credit, paying it back, buying something else on credit, paying it back, you're going to start to generate a score with credit unions. And I think I mentioned them before: Equifax, TransUnion, Experian. They're going to start keeping a log, a monthly log, of every time you repay your credit. They're going to keep a log of your deposit accounts and sometimes even your savings account. If you can demonstrate over time consistently that you can pay down the credit card, pay down the debt, and grow your savings or your credit or your deposits, your credit score starts to go up. So Ken, the question you asked is, start slow. If you can demonstrate consistently, maybe over a year, maybe over 2 years, you'd be surprised because you might get offered more credit. The knee-jerk reaction is, oh, I've got more credit, man. Go buy up this. No. More credit just means that's just more debt. If you're smart about it, you can consistently, if you need to now buy something for the house, maybe you want to buy a new couch. You can buy it on credit and you pay it back. And incrementally, you're starting to develop a reputation as being good at managing risk, is what it is. You're essentially being gauged about, are you able to manage risk?
And Kendall,
Go
I was
ahead.
going to say, there was a follow-up to that question, which builds on exactly where you just finished, which is, if you're a small business, are there particular products that are better for helping you both manage your debt load, the interest associated with the debt, but also better at helping you build a very positive credit profile in something like Dun & Bradstreet?
Man, that was great. Yeah, and that's exactly what I was just starting to go that route, where if you are a small business, and I would first say, as a small business, you want to first start demonstrating that you can generate some type of income. If you can generate some type of income, you can get a small business loan, or you can get a business credit card. And instead of using cash, you can now use credit. And I go back to a bakery. If you are baking out of your living room and you have so much demand that you say, look, I'm ready to go prime time with this. How can I go from my living room to actually getting my own place? Well, first you're going to open up a deposit account or a savings account. You're going to take in all the money that you've made in your living room. You're going to now save that, and you're going to start to see that grow to the point where you have enough to qualify for a small business loan or a business credit card. With that, you can go out and you can purchase either more equipment, or you can get a lease on a piece of storefront. So then you can move out of your living room into a storefront. Same strategy as if you're an individual. The money that you're getting, usually your revenue or your profit, you're going to take that and you're going to pay down the credit that you just got on a monthly basis. By being consistent about paying that down, you're generating a good reputation for your business. So then if you decide that you need more space or you need more resources, you will qualify for a larger loan. Get that loan, scale up, pay it down, and you're building, again, a reputation for being able to manage risk, okay? And then you're able to improve your credit score, or for a business, if you decide that you want to actually purchase your storefront instead of leasing it, you can get to a point where you've now built up enough of a credit track record where you can go back to the bank and say, hey, look, I've got a small business loan. I've got all these savings. I've got this deposit account. Now I actually want to buy that storefront. Well, then you can go and you can apply for a mortgage. And they're now going to look at all of those credit card payments that you've made as you were growing. And they're going to say, you have a 750 credit score because you've been able to manage risk on your small business loan or on your credit card loan. And yeah, here you go. We're going to give you $500,000 for a mortgage, or $800,000 on a mortgage, so you can buy that real estate. And you're going to pay that mortgage back consistently. And they're going to charge you an interest rate, and you're going to pay it back consistently. And you're going to take a portion of the money that you're getting from your business. You're going to take a portion of it and put it back into your savings, a portion of it, putting it back into your checking account. And then you're going to take a portion and you're going to pay back that loan gradually over time, right? And the other thing that people don't talk about is once you have a mortgage, once you have some of these loans, when you pay your taxes, you can claim these things on your taxes, and it will reduce some of your taxable income. And we've all seen it, how the super wealthy pay like zero in taxes and they get these tax returns. Well, it's not magic. It actually is, it's real, but it comes not from going from 0 to 100, but by taking basic steps and building a reputation for being able to manage risk. Right? I'll pause there. Ken, go ahead.
Yeah, I'm going to take the liberty of maybe asking the final question for tonight, which is the U.S. economy is I think doing reasonably well. There are headwinds on the horizon, whether they come from issues with the banking system or continued rate increases by the Fed, kind of tipping the country into a mild recession. But either way, as small businesses and entrepreneurs move through the rest of 2023, is there any advice or insight that you can share with them to help them really prepare well for any kind of economic uncertainty that they may encounter?
Yeah, Ken, that's a great question. I would say sometimes through instability or market uncertainty, I always think of it, that creates opportunity. And opportunity, or let me rephrase it. Some people say that the businesses that are growing terribly well are very lucky. The definition for me of luck is when opportunity meets preparation. So as we know, the economy may be shifting and we may be heading towards a recession. If I were a small business, and I do have one or two personal businesses, what I would do right now is I would start making sure I have enough saved in reserves for an emergency. That's one. Two, if I can store away a little bit more right now, I am, because if the economy does turn, sometimes that creates opportunity where if there was, I go back to the baking scenario, I needed to get a new range oven. A store may have suddenly discount that range oven, but because I've saved as much as I have, I can now buy that range oven at a discount, which will help me over the next several years grow my business. But the only way that I would buy that range oven at a discount is because I know I've got enough in savings, I've got enough in checking to pay my monthly bills, I've got enough covered for emergencies, and now I'm in a position to take advantage of a decline in the economy. That's one. Two, I would be de-risking right now. By that, I mean, if I have a lot of debt right now, I would slowly be putting myself in a position where I could reduce my debt, because interest rates keep going up and it's making it harder to just do the day to day. And one way to get that big monkey off your back of debt is by reducing your credit card payments, reducing any loans that you have, so that way you can reduce you can increase your monthly income but reduce your debt. Another way to do that is if you have a large debt balance right now on a credit card, you can transfer that debt to, I would find another credit card that has 0 interest for 12 to 24 months. I would transfer my debt that has a high interest, 19, 20%, to something that has 0%, and I would close that other credit card, right? I would start putting myself in a mindset that things may start to get a little tighter here. And if I'm not in a position to take advantage of the opportunity, then I need to make sure that I'm protecting myself and my nest egg if things get pretty bad. And sometimes people lose their jobs, they become unemployed. And if they don't have 3 months, 6 months, 9 months, 12 months of savings, it's going to be real hard to manage through maybe a 6-month or 1-year recession. I don't know if that answered your question, Ken, but that would be how I'd look at it.
No, yeah, no, those are very helpful ideas. Thank you.
Yeah.
And with that, we've reached 6:10. So I wanted to ask if anyone else in the course had an opportunity to ask any questions. All right, then with that, I will thank you, Kendall, for the great session this evening. I think everyone really enjoyed it, and your insights that you shared were very, very helpful. Thank you to the panel, to the participants for asking such great questions. I hope you all got a lot of information and insight out of it, particularly some of the ways that you can manage yourself in an economically challenged period that we might be facing. I think that is extremely important. And that's one of the reasons why the entire CNPP series was actually created by the SBA, which is to make sure that small businesses knew all the nuances around managing their cash flows and accessing capital in the most efficient way. So with that, again, going to thank Kendall Simmons, Managing Director at PNC Bank, for spending his evening with us and giving us these great insights, and look forward to seeing everyone else at our final class, which will be hosted next Wednesday by Mr. Simmons' colleague, Ashley Carr. Thank you, Kendall, and everyone have a great night.
Take care.